And today we have Sunny, Dennis, and Monique to share insights on the ASPAC region.
First, allow me to provide a quick update of the latest Pillar 2 development in the Asia-Pacific region. So out of the key Asia-Pacific countries, 3 countries have so far made official announcement on the adoption of Pillar 2. They're Korea, Japan, and Singapore. Korea actually passed its legislation at the end of last year for the adoption of Pillar 2 and actually caught a lot of attention because according to the legislation, it's going to adopt both IIR and the UTPR starting from 2024. Considering a lot of countries were initially considering to adopt IIR starting from 2024, but UTPR starting from 2025, this actually has put a lot of pressure on the other countries. And Japan plans to pass its legislation in March of this year, and all the detailed rules are planned to come either on the same day or right after. And in terms of Singapore, so far it only made mentioning of Pillar 2 adoption in its budgetary statement. So far, it plans to adopt both IR and UTPR in 2025. And many might ask, would all those announcements constitute substantive enactment for accounting purpose? The answer is no. So far, none of the countries have actually released enough detailed legislations relating to Pillar 2 adoption, and hence we have not reached the level of substantive enactment. And out of all the other countries, 3 countries in the region still have not made any formal indication on the adoption of Pillar 2, and they are China, India, and Vietnam. Next page, please. Next, I'll go through quickly on the latest Hong Kong foreign source income exemption regime. As many would know, Hong Kong, together with Singapore, are actually the 2 top jurisdictions for multinational companies to consider to set up their regional headquarters. Hong Kong used to have a very favorable offshore regime, but then it was placed on the EU gray list, and hence it was under a lot of pressure to revise its former offshore regime. So here we've got the FSIE, which has become effective starting from January 1st of this year. It basically covers 4 types of income: interest, dividend, equity disposal gains, and royalty. And it also adopted the same concept as what Singapore legislations have, which is received in Hong Kong. So when a Hong Kong entity receives these 4 types of income, essentially the income will be taxable in Hong Kong unless the company actually qualifies for one of those exemption conditions. So the most important exemption condition would be economic substance. So basically, if a Hong Kong company receives offshore interest, dividend, and equity disposal gain in Hong Kong, but at the same time has sufficient economic substance, then all those 3 types of income would not be taxed in Hong Kong. So what is sufficient economic substance? If a company is a pure equity holding company that does nothing else, then it would be subject to reduced substance requirement. But for any other company, essentially, it should have employees in Hong Kong and should be incurring expenditures in Hong Kong, managing the assets and bearing the relevant risks. And when it comes to interest, for as long as a company has economic substance in Hong Kong, the offshore interest would be exempt. And compared to the Singapore rule, the Hong Kong rule in this case is actually more favorable and is in line with Hong Kong's traditional position of being the treasury center. And when it comes to dividend and disposal gain, in case the company does not have sufficient economic substance in Hong Kong, the fallback position would be to see whether the income would qualify for participation exemption. So more than at least 5% of equity shareholding, more than 12 months of holding period, and the income should be subject to tax for at least 15%. When it comes to dividend, actually meeting the participation exemption might not be that difficult because when we're calculating how much tax the income is already subject to, we're not only looking at the first tier, we can actually look up to 5 tiers down to look at the taxes that have been paid indirectly at the lower level. But when it comes to capital gain, to meet the subject to tax rule might be more challenging. And actually, compared to Singapore, the equity disposal gain related rules actually appear to be more strict at the current moment. And the last type of income is royalty. Unfortunately, we would not look at economic substance when it comes to royalty income. To get the royalty income exempted, we need to look at the underlying R&D activities where the qualified expenditures were actually incurred, and we apply a fraction of the qualified expenditures to determine how much income can actually be exempted. So in general, it's a very complicated calculation and analysis, and it has become a lot more difficult to get exemption on the royalty income from offshore. Okay, that's it from me. Next, I'll pass on to Dennis to go through the latest development in Australia.
Thanks, Sunny, and hi everyone. I'm going to cover two things today for Australia. The first one are new legislation that was announced in our federal budget in October 2022, and much of this is very important for multinationals and international tax considerations. And then secondly, I'll be covering some of the recent trends we're seeing through our Revenue Authority, the Australian Taxation Office, and its reviews of multinational taxpayers. So firstly, to the legislation which was announced, and there were three main announcements. The first one was around thin capitalisation. Currently, Australia has an asset-based thin capitalisation rule, which basically applies a 60% safe harbour to net assets. That will be replaced for income years beginning on or after 1 July 2023 with a EBITDA earnings stripping rule, basically 30% of what we expect to be tax EBITDA, which will bring Australia into line with a number of other countries which have adopted the original BEPS anti-avoidance measures. As part of these rules, we'll also see a new group ratio rule being brought into place, as well as the replacement and significant tightening of our current arm's length debt test to only apply to external third-party debt going forward. So in future, it's going to be very important to understand your debt funding profile and especially revisit some of the assumptions you may have around how your debt's been done under Australia's thin capitalisation rules, because there will be significant differences going forward. The second measure was a transparency measure, which focuses on what we call significant global entities, which are the largest taxpayers in Australia, broadly entities or groups which have turnover of more than 1 billion Australian dollars. And they'll be required to provide additional tax information on a country-by-country basis, which will be recorded both to the ATO and also potentially disclosed publicly. In addition, there are some other requirements for Australian public companies to disclose their subsidiaries and the location of their residency, as well as some additional reporting requirements for tenderers for Australian government contracts, which will require, once again, disclosure of the country of domicile of their ultimate head entity. And finally, there are some intangible measures which were released as well, and these will relate to payments from 1 July 2023 and specifically provide that deductions will be denied once again for SGEs, these largest taxpayers mentioned a moment ago, where they are made to a taxpayer in low or no tax jurisdictions. So the relevant tax rate there is 15%, but also there's a focus on preferential patent box regimes as well, where there is not sufficient economic substance. It's very important to understand that this is quite an unusual rule in so much as it has no principal purpose test. It simply relates to the actual tax rate being applied. And so it'll be interesting to see how that interacts with the Pillar 2 measures that Sunny had mentioned earlier. If we just move to the next slide, we'll have a look now at some of the ATO Revenue Authority in trends we're seeing from their reviews of taxpayers. And so firstly, there's a continuing focus on what the ATO calls the 4 pillars of justified trust. And those are understanding a taxpayer's governance framework, identifying tax risks which have been flagged to the market, understanding significant or new transactions, and understanding why accounting and tax can vary significantly. So it's very important for taxpayers who are preparing for these investigations, firstly to ensure their governance is in good condition. So the Australian Taxation Office has a very strong focus on governance, but also to be able to explain clearly differences between book and tax treatments, and also to be able to explain and justify the positions taken for large or new transactions. It's also important to focus on the quality of data that you're providing. The ATO is expecting taxpayers to be able to provide in a timely fashion very good quality data and to be able to explain firstly the provenance of some of the tax disclosures in that, but also once again differences between your accounting and your tax data. And I think the takeaway then from these reviews we're seeing is to consult and prepare early. So ensure the taxpayers have a very well documented policies in place, that the business itself is engaged, and that they are able to answer the questions that we're seeing the ATO asking around these 4 pillars of justified trust in a timely and efficient fashion. If you move to the next slide, please. These are the key sort of focus areas we're seeing coming out of ATO reviews recently for multinationals. The first one is compliance with Australia's hybrid mismatch rule. Australia's rules are quite detailed, and in addition, the Australian Taxation Office has taken a very robust and very forthright approach to multinational compliance with the hybrid mismatch rules, and in particular with our imported mismatch rule. This requires taxpayers to be able to explain all the transactions within their global group and to have liaised with their overseas tax counterparts as well, to be able to explain to the Australian Taxation Office whether there are hybrid mismatches within their broader global group, whether they're imported into Australia, and the impact this may have on their Australian tax returns. The Australian Taxation Office expects, and they've said this explicitly in publicly available guidance, that Australian taxpayers will have spoken to their parents in foreign jurisdictions and they're able to explain whether or not there are hybrids in place and to have documented as such. Second one is around tax governance, as I mentioned before. So it's very important to have a strong and robust governance framework in place, because the ATO expects this to be in place and also focuses very significantly on this as part of their reviews. And then finally, it's important to document your key tax positions. So the ATO is well resourced now, they're very sophisticated, and they'll understand transactions. So they will want to understand in real time what the reasons were for adopting a particular tax treatment and the support for doing so. So to take this all back and take a step back, it's important, once again, as I said, to be prepared. The tax office is well resourced. They received additional funding in the federal budget, and that's seen by the Australian government as being a very good investment. So with that in mind, taxpayers should be across all the details in their organisation, but also ensure that other stakeholders in the business, from the finance function, from leaders, also have buy-in into the tax affairs of the company. So I'll hand over now to Malik to talk through some of the Indian developments.
Thank you, Dennis. So from India perspective, I'll be discussing two topics in the context of taxability of foreign entities in India. And the reason for discussing these two topics is that the tax authorities in India are actively looking at compliance by the foreign entities under these provisions. So the first one is in the context of foreign entities constituting significant economic presence, or SEP in short, in India. And these provisions were introduced in the domestic tax law last year. They've been borrowed from BEPS Action Plan 1. Under these provisions, if a foreign entity carries out any transaction with any person in India in respect of any goods, services, or property, and if the aggregate value of the transaction exceeds $250,000 in a year, then the foreign entity is likely to constitute significant economic presence in India. Secondly, if the foreign entity is engaged in interaction with 300,000 or more users in India, then even that foreign entity is likely to constitute significant economic presence in India. Now, what if SEP is constituted in India? In that case, income attributable to SEP is taxable in India on net income basis at 43%. Now, there are no guidelines, there are no rules prescribed to determine this profit attributable to SEP, as well as there is no guidance on interpretation of the provisions relating to SEP. Given the vast ambit of these provisions, it is likely to have far-reaching implications for all the foreign entities doing business in India, and especially those ones where they are not protected by tax treaties, as now the income earned by those entities from India without having any physical presence in India is likely to get taxed in India. Even for entities that are protected by tax treaties, there is some additional compliance burden on them. They'll have to provide some documents like TRC and some other forms to the Indian customers to ensure that there is no withholding tax in India on the income that they receive from India. Over and above that, they will also be required to file tax return in India, disclose this transaction in such tax return. Hence, these provisions will have far-reaching implications for all the foreign entities doing business in India. If you have any client doing business in India, please reach out to them, educate them on these requirements in India. Moving on to the next slide. This is in the context of dividend taxation. So Indian entity declaring dividend to foreign shareholder is required to deduct tax at 22% under the domestic tax law. Of that rate gets reduced to 10% under most of the tax treaties. Now, access to tax treaty becomes very critical here. And historically, there has been a lot of litigation when it comes to treaty eligibility for the foreign entities, and especially in those cases where the investment in India is made through intermediate holding companies. Now, the tax rate under the treaty could further get reduced if there is benefit of MFN clause available under the treaty. Even eligibility to MFN clause is not straightforward. There is ongoing controversy in India in respect of that, and the matter is currently pending before Supreme Court. The foreign entity receiving dividend from India is also required to file tax return in India if the tax is deducted under the rates prescribed in the treaty. Now, this will give an opportunity to the tax authorities to evaluate this claim of treaty benefit by the foreign entity. So all in all, claiming treaty benefit or benefit of MFN clause is not going to be simple and straightforward. This is likely to involve some kind of evaluation. Some health check should be done beforehand to avoid any potential exposure later on. So if you have any client which is proposing to repatriate profits out of India in the form of dividend, please reach out to them, please engage with them, and let us know if you need any assistance. Thank you.